Welcome to this deep dive into one of the absolute core strategic dilemmas in finance, asset liability management. We're going to break down that fundamental tension, that tightrope walk between security and return that every single financial institution has to navigate. Okay, so here's our game plan. We're going to start with the problem itself, then look at two totally opposite ways to solve it. After that, we'll get into the one key factor that helps you choose your path, and finally, how you keep it all under control. Let's get into it. So first things first, before you can even think about a solution, you have to get your head around the problem. And in ALM, the problem, the beginning and the end of the story is always the liabilities. Now, we're not just talking about a simple IOU here. The real challenge with liabilities isn't just that you have to pay them, it's about their behavior. Some of these obligations are incredibly complex, almost living things. They can be sensitive to inflation, to interest rates, even to how long people live. And that complexity, that unpredictability, is what makes crafting the right investment response so darn difficult. And this is where it gets really interesting. You see, each of these liability types is its own beast. For those guaranteed in monetary terms, you might think, easy, I'll just buy some bonds that pay out at the right time. But for index-linked promises, good luck finding enough long-term inflation-linked bonds to do the job. And the discretionary ones, well, that's a whole other headache, because you're trying to predict future decisions that depend on the very investment performance you're trying to manage. It's a real puzzle. So given this complex web of promises, what's the absolute safest play? How can you be sure you'll meet them? Well, let's explore what I call the path of certainty. In a perfect world, the solution is just beautiful in its simplicity. It's called immunization. You'd build this perfectly engineered portfolio where the cash flowing in from your assets, say from bond coupons, lands in your bank account on the exact day in the exact amount you need it to flow out to a pensioner. In theory, you could do this with zero coupon bonds. In reality, we often use clever approximations like duration and convexity matching to make sure our assets and liabilities move in lockstep when interest rates change. It's about neutralizing risk. But, as you've probably guessed, this perfect world, it's a mirage. It just doesn't exist in the real world. I mean, just take that point about the non-availability of matching asset classes. If you've got pension liabilities that stretch out 50, 60 years, where are you going to find a deep liquid market for bonds that long? You can't. And then you have regulations, like Solvency II, that might actually penalize you for putting all your eggs in one basket, forcing you to diversify even if it introduces some risk. This brings us to a classic exam question, and it's a great one because it gets right to the heart of the risk. So what happens if you deviate even slightly? Well, if you invest longer than your liabilities, you're exposed to rising interest rates. If rates go up, the value of your long-term bonds falls by more than the value of your liabilities. And boom, you have a hole in your balance sheet. On the other hand, if you invest shorter, you're now facing reinvestment risk. If rates fall, when your short-term assets mature, you have to reinvest that cash at lower rates. And you might not earn enough to meet those long-term promises. It's a real catch-22. Okay, so if perfect matching is a dream, what's the alternative? Well, you can choose to walk the path of higher return. And this means you deliberately mismatch. You accept risk, you embrace it, in the hopes of capturing returns that can actually make your liabilities cheaper over the long run. This quote really says it all, doesn't it? It is the fundamental trade-off. But let's dig in a bit. Why do you get higher expected returns from mismatching? It's not magic. It's because you're getting paid to take on risk. You're earning risk premia. So by investing in equities instead of perfectly matching bonds, you're making a bet you'll be rewarded with the equity risk premium over the long haul. Simple as that. And this chart just lays it out perfectly. Matching gives you that one, predictable, stable return. Mismatching, though, gives you a whole range of possibilities. There's a glorious upside, but there's also a painful downside. And we don't just wave our hands at that downside, we quantify it. We use tools like value at risk to ask those tough questions, like what's our 1 in 200-year nightmare scenario? How much could we lose? Managing the strategy is all about managing this entire distribution of outcomes. Okay, here's a higher level question for you. A really top-tier answer here would, of course, talk about the miner's principles. It would state that, yes, the number one job is to pay the pensions. The strategy has to be liability-driven. But it would also talk about the sponsor's goal of minimizing costs, which justifies taking some risk. But, and this is the key, only taking on as much risk as the sponsor's financial strength can actually support. So that brings us to the million-dollar question. What allows an institution to walk this riskier path? What gives them the confidence to take on the volatility of mismatching? Well, the answer boils down to the size of their safety net. And that safety net has a name: free assets. You can think of it as your surplus, your cushion, your risk capital. It's the buffer you have to absorb the bumps in the road. But here's a crucial point that's easy to miss. It's not just about the number. It's about how you calculate that number. A surplus calculated on a very conservative, regulated basis might look tiny compared to one calculated on a more realistic, economic basis. The yardstick you use changes everything.
So it's tempting to think, great, bigger cushion, bolder strategy, let's go. But it's actually a bit more subtle than that. You also have to think about the volatility of that cushion. A huge but wildly fluctuating surplus might not be as safe as a smaller, more stable one. The really sophisticated way to look at it isn't just the size of your free assets, but the probability that you'll run out entirely, what we call the probability of ruin.
And this exam question gets right to that core concept. A great answer would go beyond the basics and talk about the feedback loop. See, a good mismatching strategy can grow your free assets, which then allows you to take more risk, a virtuous cycle. But the opposite is also true. A bad run can shrink your free assets, forcing you to de-risk and sell your growth assets at the worst possible time, right after they've fallen. That's a vicious cycle you want to avoid.
Right. So let's say you've decided to take on some mismatching risk. You don't just close your eyes, cross your fingers, and hope for the best. This isn't a blind gamble. It's a carefully managed, quantified, and controlled process. And the main tool for this is something called risk budgeting. Think of it like this. You have a certain amount of risk you're willing to spend in order to buy potential returns. Risk budgeting is the whole process of figuring out how much you can spend and where to spend it to get the most bang for your buck. In practice, this usually breaks down into two big steps. First, at the very top level, the board decides the total risk the company can stomach. This is your total budget. Then, step 2 is all about carving up that budget. You decide how much to spend on broad, strategic bets, like being overweight equities, and how much to give to your fund managers to make their own active bets. The real governance challenge is making sure all those little pieces don't add up to more than your total budget. All right, we have covered a massive amount of ground here, so let's take a moment to pull it all together, consolidate everything, and really lock in the key concepts for revision. And you know, this whole strategic dance we've just walked through, it fits perfectly inside a framework you already know well, the actuarial control cycle. You specify the problem by analyzing your liabilities, you develop a solution with a matching or mismatching strategy, and then you constantly monitor the results and adjust as you go. It's all connected. So here's the whole story in 5 key points. First, the problem, then the 2 paths, then the factor that helps you decide, and finally, the tool you use to control the risky path. If you can tell this story, you've absolutely nailed the core of ALM strategy. And finally, your flashcards. These terms are the absolute building blocks. They're non-negotiable. Make sure you can define every single one, and more importantly, explain exactly how they all fit together. Which brings us to our final thought. What is the right price to pay for certainty? And the honest answer is there's no single number on a spreadsheet. ALM isn't about finding one right answer. It's about constantly managing this tension between safety and growth. It's a strategic tightrope, and the job is simply to keep walking it, day in and day out.